The opening bell rang across the floor, sharp and clean, but the sound died instantly in the wake of the numbers. On the monitors, the ticker did not flicker, it collapsed. Intuit shareholders watched as the red line sliced downward, cutting through support levels with terrifying speed. By noon, the damage was absolute. 20% of market value vanished, erased from the ledgers in a few short hours. This was not a standard correction or a minor variance in quarterly growth. It was a total wipeout. The silence in the trading pits grew heavy, thick with the realization that the old guard was breaking. Screens blinked with sell orders that flooded the system, creating a cascade of red that refused to stabilize. Investors stared at the shifting digits, waiting for a rebound that never materialized. The data points had become a death knell for the company's valuation. Every refresh brought a lower price, a deeper hole in the balance sheets, and a sharper sting for those holding the stock. The market had delivered its verdict, and it was not a warning. It was an execution. What started as a routine trading session had transformed into a structural failure, leaving the floor in a state of stunned, absolute stillness. The panic did not stop at the closing of the bell. It bled into the following hours, revealing that this was not merely a bad quarter, it was a structural collapse. While Intuit leadership announced mass layoffs and struggled with stalling revenue, the broader market narrative shifted in real time. Investors pulled capital from the wreckage, rerouting it toward companies that signaled a different future. Zoom and Workday surged, their charts climbing as Intuit's valuation cratered. This was not a random fluctuation of wealth. The market was actively picking winners and executing a ruthless purge of the old guard. Analysts scrambled to explain the divergence, pointing to the aggressive reallocation of resources toward platforms that embraced a new reality. The divide grew wider by the minute. On one side, companies clung to legacy models as their workforce numbers dwindled. On the other, tech firms gained momentum, fueled by a market that had lost patience with stagnation. The evidence was visible in every tick of the index. This was a systematic culling where the capital that once sustained Intuit was being harvested to feed the next generation of software. The message from the trading floor was cold and final. The era of the old tech giant had reached its breaking point. The vulnerability was hidden in plain sight, buried within the very processes that once defined the company. Intuit built its financial fortress on standardized tax and accounting workflows. These were rigid, predictable sequences that users followed because there was no alternative. For years, these workflows acted as a moat, keeping competitors at bay and ensuring steady revenue. Today, that moat is being drained. Large language models have arrived, and they do not respect established corporate boundaries. They are designed to ingest, process, and output data at a scale that makes manual, step-by-step navigation obsolete. Where Intuit demanded a user move through a precise, guided interface, AI agents now look at the raw data and generate the result directly. The structural integrity of the business model is fracturing under the pressure of this efficiency. These models are not just speeding up the work, they are dismantling the necessity of the workflow itself. Every checkbox, every input field, and every guided prompt that once locked a customer into the ecosystem is now a target. The software is being bypassed, rendered irrelevant by a layer of intelligence that treats the entire accounting sequence as a single, trivial computation. The barrier to entry has evaporated, and the moat is now nothing more than a dry, empty trench. The implications hit the balance sheets with surgical precision. When a user can feed raw financial data into a custom AI agent and extract a finalized tax return, the interface becomes an obstacle rather than a tool. Intuit charged a premium to shepherd users through these rigid, step-by-step processes. That premium depended on the user needing the software to perform the labor. Now, the labor is gone. The agent handles the classification, the calculation, and the final filing in seconds. The software is no longer the destination. It is merely a legacy wrapper around a task that has been commoditized by silicon. This is the moment of obsolescence. A user stares at a screen, realizes they have not touched a single menu or confirmed a single prompt, and understands the subscription fee is for a service they no longer require. The value proposition evaporates the second the AI produces the result from raw input. Traditional software relies on the friction of manual entry to justify its existence. AI removes that friction, and in doing so, it removes the reason to pay. The interface is not evolving. It is being bypassed by the very data it once intended to capture. The era of charging for the path is over, and the market is already pricing in the void that follows. While the ground crumbles beneath legacy assets, a different breed of company is weaponizing the change. Zoom provides the blueprint for survival in an AI-dominated market. They did not retreat when the tools of their trade became commoditized. They integrated intelligence directly into the core of their operations. The pivot was immediate and aggressive. Zoom transitioned from a simple video communication tool into an operational powerhouse. By embedding AI agents to summarize meetings and automate CRM entries in real time, the platform forced itself into the essential workflow of every enterprise. It is no longer just a window for video. It is an intelligent layer that extracts value from every conversation. This is not fighting the AI wave. It is surfing it. By turning raw interaction data into structured CRM entries, Zoom eliminated the manual burden that once slowed down sales teams. They converted a communication utility into an operational necessity that no company can afford to switch off. The lesson is carved in the market data. If your business model sits idle while AI evolves, you are already finished. Survival requires becoming the infrastructure that AI relies on, not the obstruction it bypasses. Zoom proved that adaptation is not just a strategic choice. It is the only way to avoid the purge. If Zoom built a bridge to stay relevant, Workday built a fortress. Their strategy shifts the battlefield from general communication to the deep, sensitive core of the enterprise. General large language models are brilliant at summarizing articles or drafting emails, but they stumble when faced with the raw, volatile reality of human capital. Workday recognizes this gap. They leverage decades of proprietary, high-stakes data to fuel AI that does not just process facts. It predicts the future of the workforce. Imagine an engine that forecasts employee churn before the resignation letter is even typed, or one that optimizes payroll structures across thousands of global jurisdictions. These are not tasks for a general-purpose agent. They require a deep, nuanced understanding of private, siloed information that no public model can access. Workday is not competing with the AI tide. They are the ones defining the currents. By holding the keys to the most sensitive data in the business world, they have created a new high ground that general AI cannot touch. While other software companies watch their value evaporate as their interfaces are bypassed, Workday's integration is woven into the very fabric of business operations. They prove that in a world of automated intelligence, the true power lies not in the code itself, but in the proprietary data that the code is built to guard. The market is no longer merely fluctuating. It is executing a ruthless purge. Where Workday thrives on depth, the middleman software companies are being systematically dismantled. The purge targets any business that acts as a simple bridge between raw data and final results. These companies exist to facilitate manual entry or basic workflow management tasks that autonomous agents now perform in milliseconds. Investors are watching the destruction in real time, breathless. At the speed of this transition, the logic is brutal. If your software requires a user to input data that an AI can ingest and process automatically, your value proposition has vanished. The market is not waiting for a gradual decline. It is accelerating the exit for any asset that functions as an unnecessary layer. This is a structural collapse of the middleman model. Billions in market value are evaporating because the software interface itself has become the primary point of friction. The purge is not a correction. It is an eviction of legacy logic from the enterprise stack. As the transition intensifies, the distance between the innovators who own the underlying data and the obsolete middlemen who just manage the input grows into a chasm. The market is teaching a hard lesson. In the age of autonomous agents, the middleman is the first casualty. The death of the software interface is not a prediction. It is an ongoing technical reality. For years, the dashboard was the king of the enterprise stack. Today, it is an obstacle. Autonomous AI agents are evolving to bypass these visual gateways entirely, plugging directly into the back-end data streams where the real work happens. When an agent can pull a raw dataset, execute a series of logic-based calculations, and output a completed result, the user interface serves no purpose. The software is no longer a tool to be opened. It is a ghost in the machine that the agent simply ignores. This shift renders entire categories of SaaS applications invisible. If your product relies on a user clicking through menus to perform a task, you are building on a foundation of sand. The agents are moving beneath the surface, interacting with APIs and databases with a speed and accuracy that no human-led interface can match. We are entering a post-software world where the value is found in the raw data exchange, not the pretty screen that presents it. Companies clinging to their proprietary user interfaces as a moat are discovering the hard way that the moat has dried up. The agents do not need your buttons, your forms, or your layout. They need the data. Everything else is just friction waiting to be deleted. The time for passive observation has ended. If you are holding SaaS stock, you are standing on a fault line. The market is forcing a brutal audit on every portfolio, and the criteria are unforgiving. Look at your holdings today. Does each asset provide a unique, non-replicable workflow that AI cannot replicate in seconds? If your answer is no, you are not holding a growth stock. You are holding a legacy asset in a post-software world. This is the moment of reckoning for every investor. You must peel back the layers of your portfolio and strip away the vanity metrics. Ask yourself, does this company own the underlying data, or are they merely renting it through a fragile interface? The agents are scanning for inefficiencies, and they are moving faster than any analyst. If a company relies on charging for manual data entry or basic, repeatable logic, their obsolescence is already baked into the code. Do not wait for the next earnings report to see the damage. The market is not just picking winners, it is actively purging the dead weight. Every asset that fails this test of unique, Defensible value is a liability you can no longer afford to carry. The era of the generic software subscription is over. Check the integration depth now, or prepare to watch your capital dissolve. The 20% plunge adding to it is not an anomaly. It is the first tremor of a much larger seismic shift. Look past the headlines. What you are witnessing is the systematic dismantling of legacy models that once defined the software industry. The market is no longer interested in excuses or historical dominance. It is actively carving a divide between those who own the future and those who are being erased by it. The separation is ruthless, precise, and accelerating. Every quarter brings a new set of data, a new earnings report, and a new opportunity for the market to execute its purge. The innovators are pivoting, integrating AI into the core of their operations to create value that remains unassailable. Meanwhile, the obsolete are clinging to structures that the new agents are already dismantling. This is a cold, calculated culling. As an investor, you are watching the extinction of the middleman. The companies that function merely as bridges between data and results are finding that the bridge has been burned. The process will not stop here. It will continue, report by report, until only the essential remain. The silence after the bell is not the end of the story. It is the beginning of a new, final reckoning.